Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right, welcome everyone. You are listening to Your Money Momentum. My name is Tom Kennedy and I have Kevin Curley here. And welcome to our quarter end, month end, first half of the year end of 23 podcast. Kevin, what's going on?
Exciting year so far, Tom. Lots happening. Great start to the year. Equities are rallying way more than people broadly expected. Banks are starting to revise estimates higher. It's the no recession.
All right, let's break it all down. We'll go over the numbers, see where we're at year to date with the first half of the year behind us, and then more importantly, we'll kind of give our thoughts on the second half of the year. What we think the markets are going to do, what to expect, where we see some opportunity, where we are going to be a little bit cautious, and we'll go from there.
Bringing you a look at the past month and what may come, here's the latest financial update.
So let's start with high level. Markets up year to date. Depending on what market you look at, I mean, you got bonds that have made a little bit of a rebound, up a couple percent. And you got the NASDAQ that's up almost 35%.
Yeah, so I think the easiest way to look at it is to start at the beginning of the year. What were expectations? And they were really bad. And the reason for that is that everybody said, oh, 22 is bad. Well, 23 will be bad too. Haven't you heard about this recession? And stocks did what they always did, which is whatever the least people expect to have happen happens. So we've seen a major rally. We had the S&P up about 14% year to date. The Russell 2000 up about 6%. NASDAQ, I mean, exponentially higher at 36.5%. And we even got some performance out of some of the developed markets internationally, up about 11%. So this is a major change from last year where the broad markets were down 20, the NASDAQ was getting crushed, the Russell 2000 was getting crushed, and it was on the backs of, well, higher interest rates, stocks can't make money, they can't do well, we're repricing, it's all going to be terrible, and there's a recession coming. I think that the stock market's a forward-looking machine. I think last year was pricing in any type of lower economic growth, whether it got to recession or not. And now it's not so much clear. We've had a banking crisis. We've had, an almost a debt default. It's climbing a wall of worry. And stocks do what they always do, which is they just go up 7 out of 10 years. Most of the time, most days are positive, not negative. And we had a really tough year last year. And those don't typically repeat back to back.
Yeah, stocks typically don't react to the same news twice. Last year was the year of rising interest rates, the Fed moving, which carried into this year. But I think the markets kind of grow numb and callous to it. But, tech, to your point, last year was down 33, 34%, and now it's up 33, 34%. We still got a couple days left in the month before the official midway mark. But anything that it flip-flopped, all the stuff that did somewhat well last year, and there wasn't much, not doing so well this year, and vice versa. So, what's interesting, though, when you look under the hood, and we talked about this last month, and things have been getting a little bit better as far as breadth, but you look at the S&P 500 up 14% year to date. It's still a handful of stocks that have been driving that return. So if you're looking at your portfolio, if you have individual stocks that aren't doing as well, the average return of the other 493 stocks in the S&P are up about 1.5-2% year to date. So big delta still between the index and the average stock within those indices.
Yeah, I think that the other takeaway is that it doesn't feel as good to recover from losses as it does to hit new highs. If you go back to January 1st of 2022, which is about when the markets peaked, we're still down. I mean, the NASDAQ's still down 9, the SPY's down about 9, small caps are down 17 from that level. So if you were buying at last all-time highs, you're just not going to feel that good. It's going to take more to get to those all-time highs and everybody to feel the wealth effect and feel positive again. Right now, it just feels like recovering from losses. And even though year-to-date performance is good, year to 18 months is not so good, still negative.
Yeah, and you're seeing it in the sector level. I mean, I think last year, the year finished where there was, I want to say, an 80% delta between the best performing sector and the worst, which was energy and tech. That isn't as wide this year, but it's the same theme. I mean, tech is up 38% and energy's down almost 10. And then we're only halfway through the year. So for annualizing those numbers, it gets even wider than it was last year. So to your point, depending on what you're buying or where you're buying it, things aren't as good as far as the individual sector level. It's you have your winners and you have your losers this year for sure. In fact, there's one, two, three, four, five sectors are actually negative for the year. The other seven are up.
Yeah, what's funny about that is that it's the exact opposite of 22. So energy's down, utilities are down. I think financials slightly down, but the big winners are tech, which was the worst performer last year. Communication services, second best performer. Consumer discretionary, third best performer. All three of those had a terrible 2022. So one of the concepts I think that's important to remember is if you look at these indices, whether it's some of these sectors or the S&P 500, is there is the concept of reversion to the mean. I know that it's been proven for the S&P 500, but one kind of the advanced maths of what we do as portfolio managers is anticipate that reversion to the mean. So something like a snapback, and you've seen this. What is it? The Dow dogs, where you buy the worst performers from last year, and suddenly they become the better performers the following year. This type of mean reversion is not unusual. This type of market of having narrow leadership is not unusual. It's completely normal stuff. This is just part of the experience.
Yeah, I totally agree. And what's been unusual about this year is that, as I was mentioning on the front end, the Fed has been continuing to raise rates throughout this year.
Mm-hmm.
In fact, the only time they just paused for the first time in over 14, 15 months, this past month, and tech is continuing to rally, which the catalyst behind tech doing so poorly last year was higher interest rates. So, speaking of which, we had a pause for the first time in the Fed funds rate, and now the market is pointing to that they're going to hike again come July.
Yeah, I think if you look at the overall bond market, it's slightly positive. If you use just U.S. Treasuries as kind of your metric, long bonds. So if you're using TLT or IEF, which is intermediate, those are up a small percentage for year to date. Even the SHY, the short term Treasuries, they're up slightly. It seems that most of that interest rate rise got priced in last year as well, and we're kind of calming down. I also think it's a big difference from going from 0 to 5% than from 5 to maybe 6%. The impact of that, the velocity, the pain you're going to feel from those rises is way different. And they've been much clearer with their communication. If you remember last March, I think is when they first raised rates. So this is about 16 months ago. They were like, maybe we'll do one this year. We'll see. And then, what was it, 11, 12, 13 in a row? They raised at least a quarter point, and they were doing 50 basis point increases at one point as well. So slowing that pace, I think it's just proof that expectations matter more than reality. When they expected a couple rate increases and it ended up being 4 or 5%, that hurts a lot. When it's a couple left, yeah, it's not so big of a deal.
Yeah, the speaking of expectations versus what the FMOC has as the year-end estimates, this is the closest I've seen the market almost in line with the Fed committee is projecting at 5.6. So the Fed's saying two more rate hikes between now and year end. Remember, just in March, or was it April, when we went through that banking crisis, they were saying two rate cuts by the end of the year. Now they're saying two more rate hikes to get to 5.6. The market's pricing in 5.2. I still have my money on the market over the Fed, but two more hikes could be painful between now and the end of the year, and something to stop this rally might be. I think a big part of this rally too is that everyone felt the Fed was getting a little long in the tooth, that the hiking cycle was going to come to an end. It's been priced in. If we get a 180 and they continue to hike and hike more than everyone anticipated, that's where this thesis, or where your 5,000 call in the S&P by year end, which by the way, you're halfway there.
Halfway there.
Could
At the midpoint. Let's go. Find me
could
one other person in America that said that, and all I saw was negativity.
Oh,
Just
Tom Lee.
I tend to
Tom
be
Lee's been
contrarian. Oh,
Tomlin's
is
been
he
saying it.
positive?
Yeah, he's been saying it for like 3 years. Eventually, he's going to get it right.
Broken clock, right? Well, hopefully 3 years from now, I'm at least beyond right. But I think that's the other thing. If you're a long-term investor, this is nice to follow. It's worth keeping track of, and it's an interesting story. But 5,000 is great. But I would anticipate, Tom, you're a pretty young guy. We're gonna hit 10,000 in the S&P in your lifetime. So if you're investing for that day, you want to be long stocks. Now, it's not going to be a straight line. It's going to be a roller coaster. There's going to be pain along the way. But if you can stick it out, that's pretty good. I think the biggest loser this year is the VIX, down 36.5%, almost inversely correlated with the NASDAQ. For that to fall off a cliff, to have that volatility disappear, I think that's kind of a healing process for a lot of folks who felt a ton of pain in 2022, where it felt like every month the statement said you lost money, the account was lower, and it didn't matter if you owned bonds or stocks, both of them were going down. Maybe if you had commodities, you did a little bit better, but that hasn't worked this year so well.
Well, speaking of the VIX, I mean, you had more. I mean, last year broke so many records from a volatility standpoint. I mean, you had more days with 1% swings up and down than any other year in the history of the VIX. You had more 3% weekly swings. I mean, you name the statistic and number in terms of volatility, it was there last year. We had very few days where it was just a quiet or silent week or day. So, and that's completely flip flopped to your point. What's interesting about the market right now is, you look how quickly the NASDAQ has run up. In fact, do you know that year to date, this is the fourth highest the NASDAQ has ever been going into the first 6 months of the year?
Like percentage wise or an actual number?
No,
Okay.
percentage wise, it's the
Oh, we had
it
some
ranks
dot-com
number
boom years.
4.
I'm surprised that we beat.
It ranks number 4, and it also did it with very few days. Very few positive days, which is really weird. So they're basically saying the days that it was up quite a bit. It wasn't just this steady increase of like 0.5% or 1% every day. It was these big swings, and what you didn't get this year were the big swings down. They just kind of ratcheted up. So that was pretty interesting. And looking at the second half of the year going back, I mean, the only years that beat it, were just a handful of years.
I'm just guessing.
Yeah, no, you're right. And the second half of the year performance was pretty good. So we'll see if the rally can last. But a lot of just a lot of extremes the last couple of years on both sides.
Yeah, before we move on to commodities and the dollar and other things, just to set expectations for the second half of the year in stocks. If you look at the forward earnings, which is what the professionals use to anticipate stock prices, the Russell 2000 is trading at 24 times forward earnings. The S&P is trading at 19 times forward earnings. Now, I will carve that out and say that those mega cap stocks are trading at like 38 or 40 times earnings, and the rest of the S&P 500 is trading much lower than that. And then the NASDAQ, 36 times forward earnings. So I would say those are pretty lofty PE ratios. What do you think of those?
No, they are. I mean, it's not an opinion. I mean, they are what they are. I mean, they're high. So the only way for the stock market to continue to go is through earnings. And, are we going to get continued earnings out of these companies? And it's hard to make that case because you have interest rates so high that it's a lagging indicator. Eventually, it eats into your earnings. It eats into your cash flow. Whether you're a small business, mid business, large business, debt carry is real. It's going to be hard in my opinion, for these companies to continue these earnings per share. Which, that's the only way you can meet the level of returns, in my opinion, because I don't think you're going to get any more expansion out of the valuations.
The multiple expansion, yeah.
Yep.
Usually that happens in anticipation of really high earnings per share growth, which is not expected, or it's anticipating cuts in interest rates. So you get a higher PE ratio ahead of that because you're discounting those at a different rate. And that's not expected either. So the only thing left in my mind that says, well, how is that possible, is inflation must be a lot higher than we realize. And I think 5% inflation makes those nominal numbers for earnings a lot higher than they actually are as far as like real growth. So if you have all the revenues for most of the major companies inflating at 5%, plus maybe they're growing at 3%, you might have some really, big revenue jumps, primarily from price inflation, not from them executing well. So I don't see rate cuts. I don't see major earnings growth. It's got to be just inflationary, but it could also be it needs to come down.
Well,
Sometimes simple explanation, right? It's
well,
too high. It's got to come down.
you're not going to get the money to go into the market, because what didn't happen this time around, and this is my big worry, what keeps me up at night, is you never got capitulation last year. You never got where the market halted and you had just everyone just got out of the market and went to cash. Everyone, the sentiment levels were there. You look at all the bears versus bulls. I mean, the highest level ever of people bearish and, not many bulls out there. People were talking the talk, but were not walking the walk. You still have all-time elevated positions in equities. You never got people going to cash or going to bonds like you saw in 2008. My point being is that there's not a lot of money to chase back into equities because it's already there. And that's one tailwind or catalyst, is that when you have people in elevated cash positions or in bonds and get back into the market, well, that naturally just will rise equity prices as more and more people chase the same amount of stocks. But that didn't happen this last time around.
I'm really glad you brought that up, because it's a perfect transition to talk about the role of the U.S. dollar. And in last year, in 2022, the S&P 500 was down 20 and the US dollar was up about 20%. And you could say, what drove markets? It was the strength of the dollar. This year, the dollar is flat, minus 1% for year to date, and the market rallies. The market has a natural tendency to go up because the companies that are underlying them are out there every day trying to make money. So it makes sense, just very logically. But if the dollar just calms down, stays flat, or goes negative, that could be the other catalyst that rises things. So I don't think you need money off the sidelines for money market, which I do think there is a ton of that. I mean, when was the last time money markets yield 5%? It was in the early 2000s, maybe mid 2000s, like 6, 7, like the last time we were at that level. So 15 years, people have said, I've had no alternative but stocks. And they go, I get 5% of money markets or treasuries or CDs. I'm taking some of the money out. So I do think there's a lot of supply to come on for cash, but if we just get the US dollar to get weaker, which given our trade deficit and our national debt, should get weaker, I think stocks can go another leg up and hit that 5,000 mark.
Yeah, I mean, you did have, I mean, at one point last year, there was almost a perfect, I think it was like 0.94 correlation to the dollar in the S&P 500, which you don't see that kind of correlation usually ever. But you're right. It's no coincidence that the dollar has lost steam and the market tends to rally. With the whole money market thing, everyone keeps talking about it, and 5%, and you can get CDs, but you still don't have high positions in cash and in bonds. But I do agree with you. I think with the dollar falling off, it's definitely going to be a tailwind for equities.
Yeah, so as far as stress in the market, the other way I would say is if you look at yield spreads, so high yield over the 10-year treasury, there doesn't seem to be any stress in the market yet. There should be, because they're borrowing in absolute terms at 3 or 4% higher rates than they were when they previously went to go market their debt. But there's no stress. So yields have just kind of moved up altogether. There hasn't been a point that says, well, high yields really exploding higher. These spreads are getting wider. That tends to be a kind of a, canary in the coal mine to say there's trouble in credit markets. So without any credit crunch, despite higher yields, I mean, maybe Royal Caribbean, a bad example to use a specific stock, but a lot of those kind of not so well-run companies that have a ton of debt that they need to refinance, they're going to be refinancing higher rates. That should crimp their style at some point. But
yeah, speaking of credit markets, you're right. The spreads, and basically what spreads are in the credit market, what's considered your risk-free rate of return is treasuries. So treasuries is backed by the government, so you get your interest and your money's good. Any spread above those interest rates is issued to corporations because you're taking on more taking on more risk, such as default risk. So when spreads widen, it means you're taking a lot of risk in the bond market. There's chances of these companies defaulting, et cetera, like you had in 2008. You're not seeing that. However, what you are seeing is you're seeing credit default swaps, the insurance against that happening, spike through the roof on sovereign debt almost across the world right now.
So you think that's where the trouble is? I
think that
say more.
it could be the calm before the storm. I mean, you saw it with Credit Suisse. I mean, and look what happened with them. So you have all these big institutionals that are buying credit default swaps, which is just insurance betting on the fact that this debt doesn't default, and if it does, you make money on it, just like it happened in 2008 with the housing crisis. So that's a little bit alarming, and you're seeing it. You're seeing it at elevated levels, like you saw in 2008. I don't know. Do they know something that we don't, or is this just a pure hedge in the event something does happen?
Um, there's a couple of things I think that are positive for the market that can keep this going besides the stuff we mentioned so far. The first one is that crude oil is down about 16% year to date, which we all fill up our cars with gas. If you have an electric car, you're using natural gas coming from a power plant, most likely, or coal. Having, we'll call it a commodity dividend by decreasing commodity prices, that's got to be good for stocks. That's got to be good for the consumer, right?
Yeah, no, I totally agree. I mean, it's a big part of inflation. I mean, think about the average person too. What they spend commuting to work, and I mean, this whole world revolves around the price of oil and natural gas.
Mhm. Yeah, it's the number one and number two commodity on earth for sure. I think that helps. And I think that being down 16% also is in line for weaker economic growth domestically as well as globally. So it's not a surprise that commodities would leave that kind of down. It doesn't mean the world's coming to an end. In fact, it can be pretty helpful. If you see commodity prices rising, that's usually kind of the end of the economic cycle. So having that decrease, I think it's helpful. The other detail is maybe the Ukraine war ends. Maybe, all those Western governments that you mentioned have credit default swaps, maybe the US government stops sending tens or hundreds of billions of dollars over there, and that just ends. And that could help with even more commodity prices when it comes to agriculture, and then all the resources being used in an actual war as well. So there's some positive possible tailwinds. That war could go on for 20 more years too. But if that were to end, I think that's a positive catalyst as well.
Yeah, I don't think we're going to have some major correction or deep recession unless there's something out there structurally like we don't know about, like why people are loading up on these credit default swaps for something catastrophic to happen or take place. Outside of something out of left field, I don't think the markets can continue to run like it has either. To your point, the valuations are way too high. But what's also interesting is the wage are the unemployment rate, and that's what the Fed's so fixated on. And it's hard to get a recession when you have under 4% unemployment. So I don't know. I think there's more tailwinds than headwinds, but I don't think we're out of the woods just yet.
Yeah, okay. I'd like to finish with, we talked about sectors, talked about major indices. The other thing that gets commented about was more popular when market had a little more dispersion was factors. So factors like quality, volatility, momentum, dividend yield. Year to date, growth has been a good factor, or that's more of a style, but quality's up over 20%. Minimum volatility, so low vol stocks, that's up about 10%. Momentum stocks still have not quite gotten their legs back. They're still down for the year, and high dividend yielders still not positive on the year. So, these momentum things, they've worked well over 10 years. The other factors that have worked is quality and minimum volatility. They haven't worked as well as the S&P 500 has. I think there's value here. I'm just not really sure how to execute.
All right, so let's end with a couple predictions between now and year end.
Get your future freezing cold takes as we launch into our latest series of Bold Predictions.
So looking at the equity market, do you think that this is going to be a continued trend of last year, meaning that the sectors that are doing well year to date are going to continue to do well year to date, or is there going to be a reversion back to the mean to the sectors that have lagged?
Yeah, I think over the next 2 months, we'll continue to go higher. Those same winners will probably either go sideways or a little bit higher. Some of the ones that haven't participated think will participate. And I think the place where we really have a lot of resistance is when the S&P gets to about 4,800, back to those all-time highs, and everybody looks around and says, things aren't that good. I think that's where you get the resistance. So I think it'll be tough to get to 5,000. I think it can happen. I don't know about rate cuts or any of that stuff, but I'm going to stick with my original January prediction and say we're going to get there by the end of the year.
Yeah, I think the opportunity is in the laggers this year. I don't think you can have companies like Nvidia that's up 300% year to date, and some of these mega cap tech, just because they've mentioned AI in earnings calls, continue to run. So I'm favoring the sectors that have better valuations. The cyclicals, financials, energy. I think you'll see a reversion back to the mean, and those will be the better performers between now and year end.
Yeah, I mean, I think that the stuff in housing is good, like home builders doing well. That's a good sign, right? That's economic growth. That is a big chunk of the economy. If those keep going, I think you can probably hang on. And inflation hasn't gone away, wage growth hasn't gone away. People are all right.
Yeah, I think so too. So last question: over under on rate hikes between now and the end of the year at
We already
2.
set this line.
Well,
I'll take the over.
Take the
I'll take
over
the
on
over too.
more
Yeah.
than 2 rate hikes.
Yeah. First of all, the Fed doesn't know what they're going to do. So
Yeah.
that's number one. So predicting this is hilarious because the people who are predicting about don't have any idea what they're going to do. But I think that the problem is what we talked about in previous podcasts is unless they say, hey, we got inflation down to 4% and declare victory, they have to keep going.
God, I hope it's not over.
If you're going to get to 2, you got to keep going.
I'm going to say I'm going to go with the market's predicting, and I'm going to say one more.
Even money.
I think it's gonna. I think there's one more hike. I think it's gonna happen in July. I think the market's gonna not respond favorably to that, and then I think they're gonna pause between now and the end of the year with a potential cut in December.
All right. Well, I will finish by saying, don't forget about Nikki T's book, The $1 Trillion Triage, which was all about the Fed. And he said, we keep a picture up of Arthur Burns in the Fed. They walk by it every time and go, don't be Arthur Burns. So they're going to raise rates until they beat inflation. That is what my final bold prediction is.
Oh, God. Well, I hope you're wrong.
Me too.
Well, on that, we will be back in a couple weeks with our mid-month podcast. Thanks, Kevin.
Thanks, Tom.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.